A very good morning to all of you students. My name is C.A. Divas Gupta and today we will be continuing on the topic of interest rate risk management. So students, in the last session, we have covered the concepts around asset and liability management, which is ALM, forward rate agreements, interest rate futures and interest rate options. So let's take our session ahead. So let's start with question number 5, students. Question number 5 from the assignment, it says TMC Holding Limited has a portfolio of shares of diversified companies valued at 400 crores, enters into a swap arrangement with non-bank on the terms that it will get 1.15% quarterly on notional principal of 80 crore in exchange of return on portfolio, which is exactly tracking the Sensex, which is presently 21,600. So they are saying that they are holding an investments of around 400 crore. Out of that 400 crore, around 80 crore worth of principal, which is invested into different companies, is giving them a return which is exactly equal to the Sensex returns, right? And they might be fearing that the returns that they are getting are uncertain, it is bound to change, and hence they will have to curb the risk of the uncertainty in the returns. And how they are doing so? By exchanging it with a 1.15% quarterly return. Okay. Then calculate the net payment to be received or paid at the end of each quarter if the Sensex turns out to be 21,860, 21,780, 22,80, and 21,960. So they have given us 4 different values and they're asking us to calculate the net amount to be paid or given. Now, first of all, students, here we are talking about a swap, which generally means an exchange. Now, exchange of what and what? So, exchange of Sensex returns on one hand, which is actually driven by the changes in the Sensex, right? So, what it is, 21,600 is at present, then it is 21,860, then 21,780, 22,080, and 21,960, right? So there is some percentage movement here, there is some percentage movement here, we will see to it, and some percentage movement here, either up or down. Now for a moment, I am saying, let's say, okay, this is 2% up, then this is, let's say, 3% down. I'm just taking it hypothetically, okay? Now, the exchange is with fixed return of 1.15% per quarter. This is the fixed return. So the TMC holding will get 1.15 and it will pay whatever TMC holding is earning on the notional amount of 80 crore because of the Sensex movement. I hope the question is clear, students. So this 1.15% per quarter on notional amount of 80 crores. Okay. So if we just write it out, so TMC holdings get 1.15% on 80 crores, right? So, and it will pay, so TMC will pay basis Sensex returns. We can put now in the form of a table quarters, the Sensex values, percentage change in Sensex, amount, then the fixed return that we are getting, and hence the net amount. Okay. Now we can just compute. First of all, we'll start with the 0th quarter, which is, let's say, the base quarter, in which the Sensex was 21,600 students. Then 21,860, we can term it as the first quarter. Then the second quarter is 21,780. Third quarter, 22,080. 21,960 is the fourth quarter. Percentage change in Sensex. So the first quarter is nil. Then the second one, we can maybe put here for the first quarter. I'm just writing the formula. How have we arrived at? 21,860 minus 21,600 whole divided by 21,600. So if we solve this, students, what is the value that comes? 21,860, 21,600.
1.20%.
Okay, thank you. Yes, 1.203. I'm just writing it for the 4 decimals, 1.2037%. Similarly for second quarter now. Now in case of second quarter, the change will be from these two values, students. 21,780 and 21,860. 21,780 minus 21,860 divided by 21,860, which is the previous quarter's base. Then the value comes out to be 21,780. This minus this. So minus 80 comes to the numerator and 0.2 366. So we solve this, it comes as minus 0.3660 percentage. I hope this change in Sensex calculation is clear to all of you. 0.3660 percentage. See, the only catch here is that we are just taking the previous quarter as the base, and on that base, whatever is the increase or decrease, we are just calculating that. Now for the third quarter. Third quarter is 2280 minus the previous quarter to the third quarter, which is second quarter. The closing value was 21,780. This whole divided by 21,780, right? Twenty-two zero eighty. There is an increase by 300 on the base of 21,780. So this is 1.3774 percentage. Clear? And 21,960, which is the fourth quarter. 21,960 minus 21,960 minus 22,080 divided by 22,080, which is the previous month's, which is the previous quarter's value. So this comes out to be 22,080, 21,960. Minus 0.5435. Five, 4, 35% students. So this is the change in Sensex that we have calculated in terms of the returns going up or down. Clear? Any confusion in this calculation, students? This is calculation of Sensex quarterly returns. Okay. Now the next point is that we'll have to calculate that what is the amount it translates to. So what is the notional amount, students? 400 crores enters into a swap that it will get 1.15. So what we will do for the swap of 400 crores, we will multiply the respective values in the change in return of the Sensex. So we will just do this, which is 400 crore into X percentage into percentage change in Sensex. Clear? So this is nil. Here it will be, so we can say calculation of variable returns. So this is just to make you understand, okay? Even if you just directly put it over here, that is also fine. But this is just to make you understand that for quarter 1, 2, 3, and 4, percentage change, let's say, is, okay, let me write it over here, 1.2037 Second is minus 0.3660 percentage. Then 1.3774 percentage minus 0.5435 percentage. The amount, we will take it as 400, 400, 400, 400, and the amount of variable return comes out to be sorry, 4.8148. So this is just, we are multiplying, that's all. Multiplying, and then is equal to minus 1.4640. This multiplied by 400, 1.3774, 5.5096. This multiplied by 400 is equal to minus 2.1740, right? So we'll just put these values above in this box. So the first one is nil, then the second one is 4.8148, then minus 1.4640, 5.5096, and then ultimately minus 2.1740. And then the fixed return, students, is simply fixed return. So here we are not taking 80 crore, students, we are taking entire 400 crores for the swap. Okay, so just note this point once. This is entire 400 crores swap. That means 5 swaps they have entered of 80 crore each. Now fixed return of 1.15 percentage on 400 crores will come out to be 4.60 crores. So every quarter they will be getting 4.60 crores in terms of the fixed return. Here also, even if there is a loss, even if there is a loss of minus 1.4640, they will still end up getting a fixed return of 4.60 crores, right? So even here as well, so that is the essence of a swap, where it does not matter whether you are having a gain or loss, whatever are your commitments, that you will exchange those amounts, those variable amounts from the fixed amounts. So that will happen. Okay. So if you see, the TMC holdings will pay this much amount and will receive this much of amount. Correct? The total of this, basically. Then the net amount, if let's say this is A and this is B, okay, or we can just write that whatever it will receive as A and whatever it is paying as B. So this is A and this is B. Then A minus B will be 4.6 minus 4.8148. This will be minus 0.2148. Then 4.6 minus 1.4640. That means 1, I will be recovering the loss.
It will be in plus no.
Sorry?
Sorry.
Yeah. So one is I will be receiving the loss as well. I will be receiving the fixed amount as well. So both these put together, I will be receiving. So 4.6 minus 1.460, which is actually plus. So 2 times minus is plus. So this will be 6.0. 640. Clear? Then 4.6 minus 5.5096. So this will be minus 0.9096. Then again, the loss of 2.1740 will also be recovered apart from the 4.6 that we are receiving. So even this amount will be recovered. So the total amount is 6.7740. Okay. So let's do a total here. Or we have been asked for the... No, okay. So they're asking us to calculate the net payment to be received, paid at the end of each quarter. So that's fine. So till here it is fine. Okay. So these are the amounts that will be paid or received at each quarter end. So students, I hope through this small example, the understanding of swap, which is relatively easy, is understood, right? Any questions, students, in this? Okay. Now let's move ahead. Now let's come to the discussion of interest rate swaps. Okay. Now let's come. So we have already introduced the topic from question number 5, but now here we will be discussing about how the swap is made, why swap is made, right? What are the peculiarities while swaps is made? What are the specifications that are there? Okay. So let's talk about interest rate swap. So there are two companies, company A and there is a company B. Let's assume there are two different companies. Now company A is a well-established company. It's a very old company, right? Which is already reached a stage where the profits are getting generated in good amount, where even the relative cash flows are there, the stable cash flows are there, right? For the company. So it's a well-established company. Company B is a new company. It's like a startup where relatively the things are new in company B. They are yet to earn good amount of, let's say, they are yet to reach a situation where they are having a stable earnings, right? Both of them are in need of funds. So company A also and company B also. Both of them are in the need of funds. Company A will prefer to borrow on floating basis. Now, students, first of all, we need to understand that whenever we talk about any interest rate loan, or let's say any borrowing for that matter, or even investments. So there are two ways to do it. One, you say that I will be borrowing on a fixed rate basis or I will be borrowing on a floating rate basis. What do we mean by this? Fixed rate basis means that for the entire term of your borrowing, the rates are fixed, let's say 10%. In case of a floating rate, the interest rates are not fixed, they are linked to some of the index movements, some of the benchmark rate movements. So let's say in case of floating, we can come across it as a MIBOR plus 1% case. That means, so MIBOR is what? Mumbai Interbank Offered Rate. So that means this is the rate, interest rate at which banks borrow or lend within banking industry. Clear? So this is the rate at which the banks will borrow or lend within themselves. But in case they are giving a loan to someone outside, so what they will say that okay, MIBOR is the benchmark rate. This is called as benchmark rate, and they will link their bench. So because benchmark rate will keep on changing, right? Let's say today it is 7%. Tomorrow it can be 8%. After 1 quarter it can be 10% or it can be 5%. So it is totally dependent on the demand and supply of the credit in the market, the Reserve Bank of India interventions in the market through the policy rates that they publish. Clear? So it is a kind of a benchmark rate, students. Now, can you give me example in real life? We will come to the swaps, but let's understand in real life which kind of loans are fixed and which loans are floating. Can you give me example? Let's say today if you go to a bank to take a loan, right? Just one example.
Fixed would be the car loan.
Okay, very good.
Floating
Home
would
loan.
be a home loan.
And in
Automobile loan.
floating, we have the CC loans.
The cash
CC
credit
loans,
loans.
cash credit loans, PS50 loans.
Home
Yes,
loan
very
would be
good.
floating.
And home loan as well. Very nice. Very good. Why it happens? Why home loan comes under floating? Have we ever thought about it? Why will bank would want to put home loan under floating? Why not under fixed?
It is generally of a longer period, so they
Yes.
can recover the interest in the earlier period.
Correct. Correct. So if you see, the bank is thinking that the home loan is generally, let's say, for 15 years. Now, if for 15 years, if I'm committing, let's say, 10 crore in the form of a home loan, right? And if I give it on a fixed 10% basis, tomorrow the interest rate increases to, let's say, 15%. Bank will have a loss of 5% because in this case, the interest rates have gone up. So what will bank do? Bank will say, okay, this 10 crores of home loan, I will link it to a rate which is again, let's say MIBOR or their base rate of the bank, and on that they will add the spread that they want to add. So that whenever the interest rate is changing, they are marking themselves to the market in terms of the recoverability that they're doing. So this is also one of the way they have mitigated the interest rate risk to them. See, this is a situation of interest rate risk only, right? That market interest rate is 15% and you are only recovering 10% on your investments. Because for bank, giving home loan is an investment. Correct? So if you are recovering only 10%, but in the market, 15% either you can pay to borrow or receive on your investments. So still you are having a 5% delta. So to manage this, you can convert this loan into the floating rate. Clear? Then it also comes about the preference of the borrower, right? Sometimes, as I said, that company A and company B, they have their own preferences. Company A wants to borrow in floating because they feel that while their, or let's say their risk management committee would have felt that while they are okay to give a little extra on the higher side, but still in the floating, they think that if there is a downside in the interest rate, they will be able to save more. Let's say they would have done some sort of calculations, hence they have come up with their preference of floating percentage. Similarly, company B is a relatively new company, right? They don't want to take the risk, so they will prefer fixed. Clear? Now both of them actually goes to their respective banks. So company A goes to its own banker, which is bank A, and company B goes to its own banker, banker B. Now banker A says that in case you want to borrow on a fixed basis, you will get 7%. In case you want to borrow from me on a floating basis, I will offer you directly my version. Because your credit worthiness is good, so I can offer you directly my rate. I will not charge any spread from you. Just for hypothetical assumptions, okay? Now bank B says to company D that in case you want to borrow from me, in case you want to borrow in fixed, I will say it as 10%. I will charge you 10%. In case you want to borrow on floating, then it will be MIBOR plus 1%. Clear? So they are charging plus 1% on MIBOR for bank B, for company B. Now see, one way is that company A will just borrow in MIBOR and it will say that the borrowing is done. And similarly, company B will go and borrow at 10% and they will be closing their deal. So this is one way to look at it. But they thought that both these proposals, let's approach to another bank called Swap Bank. I'm taking in this example these different parties so that you are able to understand it better. So both these companies approach a third bank called as Swap Bank, which is a separate bank altogether, and they brief their cases to them, that what are their preferences, right, and how do they want to borrow. Now what does Swap Bank does? It quickly do a calculation. Okay, what is that calculation looking like? Option 1, that I will ask company A to borrow in fixed and company B to borrow in floating. This is option number 1. So it is trying to put down different options. So 7%, right? In case the company A borrows in fixed, plus company B in floating. So that is MIBOR plus 1%. This is actually MIBOR plus 8%. So this is option number 1. So this is a collective borrowing obligation. So Swap Bank is saying, okay, let me first of all not think about their preferences. Let me first of all think about their optimum solution, right? Then option number 2. It says that let A borrow in floating and B borrow in fixed. And this was what? This was their individual preferred borrowing case, right? So this is MIBOR plus 10%, right? So floating for A is MIBOR and fixed for B is 10%. So overall it is MIBOR plus 10%. Clear? Now, if we compare both the option, students, MIBOR plus 10% and MIBOR plus 8%, which one do you think is more beneficial? Option 1 or option 2, students? Come on, tell me.
Option 1.
Yes, option 1. Reason being, option 1 is having 2% lower overall net exposure. Right? So, Swap Bank tells company A to borrow in fixed and company B to borrow in floating. So, this is the first leg as of now. So, what will Swap Bank tell company A to do? You can just borrow from bank A loan taken, and in return of that you pay 7% fixed rate of interest to bank A. Similarly, for company B, the bank B, it says that okay, you take the loan taken, and the interest payout will be MIBOR plus 1%. Correct? This is how the swap bank has finalized the option. Now company A will say to the swap bank, now what about my preference? I came to you for a solution, but you have asked me to borrow in fixed. My preference is to borrow into floating. So what will swap bank say? Okay, you have a preference to pay floating, then you pay me MIBOR equivalent. Okay. Now company A, what it will say? I am paying this 7% also and I am paying MIBOR also. So my overall liability is MIBOR plus 7%. I am paying MIBOR to you and 7% to bank A. So my overall liability is MIBOR plus 7%. So swap bank then will say to company A, I will also pay you something in exchange of this MIBOR. I will pay you a fixed rate of 7.75%. So as of now, don't go into this how it has come. I will cover that part as well, that how this 7.75 has come. But as of now, just see to it that there is some fixed amount that will be received by company A and MIBOR will be paid by company A to the swap bank. Clear? Now company B is also standing with the swap bank. It will also say to the swap bank, now what will happen to me? I have a preference to borrow in fixed. You have asked me to borrow in floating. So what will swap bank do? Swap bank will say that to the company A, okay, you pay me fixed. You pay me a fixed of 8.25%. You pay me a fixed amount of 8.25%. And company B will now say that I am paying MIBOR plus 1% and 8.25% to you. So swap bank will pay to company B an amount of MIBOR equivalent. So company B will receive MIBOR equivalent amount from swap bank, and company B will pay MIBOR equivalent amount to bank B. So receiving and paying will get knocked off. So for company B, ultimately the net exposure will be 8.25 plus 1%, which is this one plus this one. So 9.25 is the collective amount. And here it is MIBOR minus 0.75% becomes the net amount. So let's write it. So first of all, students, after swap, now I'm just explaining how have we arrived and other numbers implication after swap. So you understood the swap. The swap is that the fixed is getting swapped with the floating rate. So this is the swap, students. So till here, this one is the swap. And similarly here for company B, this one is the swap. So swap is where you are exchanging your fixed payments with the floating payments, or you're exchanging your floating payments with the fixed payments. Yeah. So what will happen after swap? Company A, if we talk about, company A is what it ends up paying, MIBOR plus 7%. So MIBOR it is paying to swap bank, 7% to bank A, and it is receiving 7.75 percentage. Pay to swap bank plus 7%. This is pay to bank A minus 7.7%. This is receive from swap bank. So this is M minus 0.75 percentage, students. MIBOR minus 0.75 percentage. This is a floating rate obligation for company A. So converted into floating rate obligations. This is clear? Now about company B.
Initially for company A, it was fixed 7%. Now it has changed to MIBOR minus 0.75%.
Correct.
So
it has changed to MIBOR minus 0.75%. Yeah.
So is there any benefit to this company by doing
Yes.
this?
Yes. There is a benefit. So
We
how?
didn't know MIBOR.
How there is a benefit? Yes. So that's the right question. Now, if you see, had company A directly went for a borrowing with bank A, they would have borrowed at MIBOR directly, right? But because of the swap, their overall is MIBOR minus 0.75%. So there is a benefit of 0.75%. Clear?
Yes, clear.
Yeah. So this company B was paying MIBOR plus 1% pay to bank B minus MIBOR receive from swap bank minus MIBOR plus 8.25% pay to swap bank. So this minus MIBOR and plus MIBOR will get cancelled out, and overall it will be 9.25% as fixed. So converted into fixed obligation. And students, again, if you see the same logic, if we apply here, what was the benefit to company B for entering into the swap? Had the company not entered into the swap, it would have been paying a 10% fixed now. But because of the swap, its overall interest obligation is only 9.25%. Okay.
Sir, in that case, how swap bank is going to earn? Or either bank A or bank B?
Yes, I will come to that. So that's a good question. Now, what is swap bank doing? Swap bank is not doing a charity. So what will swap bank do? Now, in between this, right? Where were we? Yeah, here. So this was the entire story. Now the swap bank will also keep a 0.5% commission through this pricing. I'll tell you how. So till now, if we just add up what all things are happened, so what is the total collective payout? If we just total it out, so the first one was MIBOR minus 0.75%. Okay. Then company B will also be paying 9.25%. So this is plus 9.25%. So this is their overall interest outgo. How much it is? Interest payout. That is happening from both the company's pocket, right? Company A and company B collectively they are making a payment of MIBOR plus 9.25 minus 0.75, 8.5%, right? So this is MIBOR plus 8.5%. And this is the total obligation that both the companies are paying off. What was our option 1? Because what was the calculation of option 1 that the bank said? MIBOR plus 8%, right? So this was rejected. This option was rejected. Correct. So I am not taking MIBOR plus 10% because this got rejected. I am just taking the accepted proposal. So this was accepted. Option 1 was accepted. Now, option 1, as per this, it should be MIBOR plus 8%. So received by Bank A and Bank B was how much? MIBOR plus 8%, right? This is the option 1 value. So that means the extra payout of 0.5 percentage as per the calculation that Swap Bank has kept its own commission. So you see, in this case, all the three parties got benefited. Company A, Company B and Swap Bank. Right? Company A, Company B and Swap Bank. It's just that Bank A and Bank B are still getting as per their own proposals, right? Which is the fixed or floating, whatever they have proposed. The benefit has been split. And how it has been split, if I may want to tell you. Till now it is clear.
I'm wondering who is losing here 0.5% because Swap Bank is gaining 0.5%.
Yes. So I'll tell you. That's a good question. So now I'm just writing the last bit in this. Then I think your doubts will be clear. Okay. So it is sounding like I would say it's a commercial arrangement though, right? So okay, let me just say here option 2 and option 1. Option 2 was having an overall obligation of MIBOR plus 10%, right? This was worked out by Swap Bank. Worked out by Swap Bank, right? I'm talking about those two options. Minus MIBOR plus 8%, right? So I'm just trying to calculate the differential here. So option 2 was a costlier option and option 1 was a cheaper option. So we finally went ahead with a cheaper option and we saved 2%. Correct? We saved 2%. Now, this 2%, how it got split between the three parties, Company A, Company B, and Swap Bank. Would anyone want to answer this? How it got split? How this 2% got split between these three companies? You just need to link the above that we discussed just now. Would anyone want to answer?
0.75 to each company and balance to swap.
Yes, very good. So 0.75 to company A, 0.75 to company B. So this makes up as 1.5 and 0.5 Swap Bank will keep, hence overall 2%. So through all the calculations, let's say I've tried to, let's say, depict this through multiple ways. Okay. So the one way is this, if I say, okay, my total saving between both the options was 2%. If I am giving a benefit of 0.75 to company and company B, 0.5 should remain with me and hence overall 2% is the breakup. This is also proved by the fact here that 0.5 is the extra amount because the overall payout is happening this much. But MIBOR plus 8% is what the Bank A and Bank B is receiving. That is 0.5 is kept by Swap Bank. Clear? And another part is this one, which is in this case, company A is having MIBOR minus 0.75. So that means 0.75 is the saving here for company A. And company, because had it borrowed, it would have borrowed at directly MIBOR. That's where there is a saving of 0.75%. For company B, had it borrowed in fixed, it would have borrowed at 10%. But because of the swap, its overall borrowing cost is coming out to be 9.25%. and hence there is a saving of 0.75%. So you see, students, through all the different means we have tied up the equation, and I hope you understood now how Swap Bank would have back calculated these numbers.
Sir, in our country, which bank is working as a swap bank, or there is nothing fixed?
No. So in our country, all the banks can work as a swap bank. So in reality, this bank A and swap bank are generally the same parties. Okay, in my example, I have created a separate identity. But what happens? Let's say you are taking a loan today. Okay, or let's say you have a foreign obligation. It can happen. So what it will happen, that the swap bank, the regular banks are swap banks. Just to answer your question first, okay? Let's say HSBC acts as a swap bank, right? All the Indian banks, all the Indian PSUs banks also can act as a swap bank. So they will give you a quote that if you already have a loan or a borrowing at the rate of 10% fixed, we can convert it to floating by this and this amount. Okay.
Okay, sir. Thank you.
Okay. So this is a very simple swap. Okay. This is a very, very simple swap. Now, because I can see the level of interest that is developing in all of you, I can even talk you through a very complex swap. Okay. Although I'll just take 5 minutes just to make you understand in practical life how swap works. Okay. So that so this is a currency swap that I'm talking about now. Okay. Let's say there is a company A. It has a foreign subsidiary called as company B. Okay, this is a very practical example I'm taking. So this company A has given a foreign currency loan to company B, let's say $1 million. So company A has given loan to company B, okay, in $1 million. This company A is, let's say, in India, and hence they are having their domestic currency as rupees, their functional currency as rupee, right, as per the accounting in India as well. And this foreign subsidiary, let's say they are having dollars and dollars only. I mean, dollars as the foreign currency as well as dollars as their local currency. Okay, let's assume it to be a country where dollar is the local currency. Now, if you see here, there is one more element. The loan has been given at 3% per annum fixed rate of interest. Okay, they will be, because they cannot give at a free of cost, right? The loan, they will have to charge the interest, so they are charging 3% per annum. Now in the back end, company A approaches a bank in India, let's say bank A. Okay, so bank A will say that, okay, you give me, okay, let's enter into a swap. The $1 million loan that you have given to your foreign subsidiary, okay, I will pay you $1 million to you. You pay me, let's say 800 crores. Let's say this is the INR value. At the rate of 80, I have taken for simplicity. You pay me 800 crore in INR. Okay. And the interest obligations are such that I will keep on paying you 3%. Wait. You pay me 3%, right? So the company A will pay 3% in terms of the interest rate I'm talking about. And company A will receive from Swap Bank 7%. Just to be more clear, let me just rewrite this. Company A will pay to Bank A and Bank A will pay to Company A. Clear? So they have actually swapped the interest rates as well from 3% to 7%. So what is happening here, students? One, first of all, the principal got swapped. Let's say this was a loan for 3 years. Okay. This was a loan for 3 years. So on the day one itself, Bank A had given $1 million to Company A. Company A had given those $1 million to Company B, which is a loan to the foreign subsidiary. Okay. Then Company A would also pay to Bank A, right? So they have paid 800 crore. So one, there is a swap of principal amounts. See how many swaps are working here. One, there is a swap of principal amount. So this is on origination. Okay, on origination. So 800 crores got swapped with $1 million. Now somebody might ask you, what was the need of doing this? Can you tell me what was the need of swapping this amount?
The company A will receive the funds immediately, which it had loaned.
No, but if you see, the company has received $1 million and paid also to company B. So dollars are not with company A, and company A rather have invested 800 crore, right? In Bank A. Because it has paid 800 crore. So what was the real reason to swap the principal amount? To mitigate foreign currency risk. So imagine if company A would have not entered into the swap, the company A receivables in the balance sheet would be showing $1 million as a loan given to subsidiary. If there is adverse foreign exchange movement, it would have impacted the profit and loss and the balance sheet valuation of the company, right? So in a way, to mitigate that risk, the company A offloaded the foreign currency risk from the balance sheet by swapping it against a fixed amount of INR 800 crore. Clear? So this is first leg. This is first leg. Second leg, 3% on $1 million getting swapped with 7% on 800 crores. Why? Because now your investment of company A, investment of company A got converted from dollars to rupees, and hence the interest rate applicable to rupee should be applied. So students, I hope all of you are aware that the returns on dollars, right, that the return percentage on the countries where dollars operate as the primary currency ranges between 2.5, 3.5%, right? But countries like India, where it's a developing country, the inflation is there and the GDP growth is there. Generally, we have seen the interest rates are in the range of at least 5%, 6%, 7% on the investments, right? On the rupee investments. So they will also swap this, correct? Then after origination on maturity, also there will be a last swap on. Now what will happen on maturity after 3 years? Company B will pay back company A $1 million. Now what will company A do for that? Company A will give back those dollars to bank A, and bank A will give back 800 crore rupees to company A. So on maturity, company B will pay back company A $1 million, and company A will give to bank A these $1 million, and bank A will give back 800 crore rupees on maturity. So company A has got its 800 crore back, and for 3 years company A have earned 7% fixed rate of interest without any currency risk, without any interest risk. You see the point of this swap? So in a nutshell, company A has invested 800 crores at the rate of 7% per annum for 3 years in India. Why I am saying in India? Because it has avoided currency risk. So the substance over form is this of the entire swap here. Clear, students? So I am saying the swaps can take multiple forms. It can take multiple risks into account. In this, I have not introduced, let's say, the floating to fixed conversion as well. Even this can be complicated where the principal amounts are getting exchanged, that is fine. But let's say this was a floating rate borrowing. So even the interest rate of floating to fixed will also be swapped in such a case. Okay? Clear?
Sir, but overall profit or gain will be known only at the time of maturity based on the foreign exchange rate. Or here
Why do
on,
you say so?
but or here is just breaking even, loss or profit.
No, I will say that you already know what is your profit or loss because you have already swapped your principal amounts as on today. See, your cash flow is going to be fixed. Let's say, I'll just give you an example. Let's say the dollar rate was 80 rupees when you have given the loan. Okay. Now, after 3 years, the dollar rate have become 90 rupees. It will not matter to you because you will receive $1 million from company B at the rate of 90 rupees, and you will hand over the same $1 million at the rate of rupees 90 to bank A. So it has come and it has gone. So you have received dollars and you have paid dollars. That's all. But from
Also,
bank A, you
bank
will get
will pay a little less than, no?
no,
Less
no,
than
no,
a 90 rate.
no. Bank will pay me the exact 800 crore rupees for which I have entered into the swap. See,
Yeah,
that
that is
is
okay.
yeah. So that is where your risk is getting curbed, na? Because the bank, okay, what is bank A and company A has entered into? That today we are swapping $1 million and 800 crore. After 3 years also, we will be swapping it reverse. The 800 crore and $1 million, whatever the dollar rate may be. So if you ignore this part also, bank A will not pay any differential of the dollar difference, the rate difference to company A. The bank A will not pay. The reason of this, actually lies in the rate of interest of 3% and 7%. I think the point that you are touching is very important. Now I am explaining that further because you have asked it. So have you ever wondered why in rupee terms we earn higher than in dollar terms? Because rupee is depreciating. So eventually this 7% will have two components. One, 3% of the global returns in the form of dollars and 4% return because of the currency devaluation. You would have studied what is that parity theory in foreign exchange management. Can anyone remember? The foreign exchange risk management, you would have studied, right? Currency, I'm not able to recall. There is a parity theory, right? Which says that the dollar interest rate is linked to the INR interest rate with some of the factors. So this is the indication of this is that. So in a way, bank have already covered you for the currency devaluation by giving you 7%. So here bank will not give you anything extra. I hope the query is clear.
Yes, sir. Thank you.
Okay, so this was all about the swap. Let me see, is there something else on swap that we need to discuss? So if I come back to this part, which was this one, there is a last statement that I'm just drawing here. So comparison between pre and post swap situations. No swap, swap, and then let's say savings. We all know that there is a savings. Company A, had it been no swap, it would have been paying MIBOR, and after swap, it is paying MIBOR minus 0.75%. So there is a saving of 0.75%. Company B, no swap, it was 10%. Swap, it was 9.25%, right? The overall outflow of the interest was 9.25 only in case of swap. So it became 0.75% as the saving. And ultimately, swap bank would have not earned anything here. 0.5% has been earned in the swap bank after swap. So ultimately 0.50 is the overall saving. So this comes out to be 2%. So this is the overall savings, students. Right? Which we all know, which was the difference between option 2 and option 1. So this brings us to the close of the discussion on swaps. Now we will practice some of the questions to take it ahead. Let me see if there is any query. Okay, I can see some of the messages received from B. Kiran Kumar. Okay, thanks a lot, B. Kiran Kumar, for the messages, and congratulations to you for clearing the groups. Thank you, B. Kiran Kumar. Okay, thank you. Yes, so let me come back to the question number 6. Consider the derivative bank entered into a swap arrangement on a principal of 10 crores and agreed to receive MIBOR overnight floating rate for a fixed payment on the principal. Now, this is a very interesting thing of overnight floating rate. I will explain this. Okay. So, receive what? Receive MIBOR overnight floating rates. This is receive and pay fixed payment on principal, right? Principal is how much? 10 crores. The swap was entered into on Monday, August 2019, and was to commence on 20th August. So that means it has to come into effect from the next day and run for a period of 7 days. Respective MIBOR rates for Tuesday to Monday were 1, 2, 3, 4, 5, 6. So they have given us the 6 rates. If the fixed rate of interest is 8%, then evaluate. If the nature of the swap arrangement, the net settlement amounts. Sunday is a holiday. You just imagine Sunday is a holiday. That is okay. So hence they have given us 6 days rates, right? Because Sunday there would have not been a rate. Work in rounded rupees and avoid decimal. Consider 365 days in a year. So they are asking us, first of all, what is the nature of the swap arrangement and what is the net settlement amount. So first of all, students, let me explain the meaning of this term, MIBOR overnight floating rate. Okay, MIBOR overnight floating rate. This is what we need to understand first. Yes, so first of all, students, as I said that an interest rate is always expressed in terms of its maturity. Always do remember this. This is a very, very important topic. I mean, concept. So if in my previous class also, I have discussed this, right? MIBOR of 6 months is, let's say, 4%. MIBOR 12 months will be higher than 4%, let's say 4.5%. This I am talking about on a per annum basis only. But for a 6 months maturity loan, let's say the MIBOR, which is the market interest rate, it is charging it as 4%. For a 12 months maturity, it's slightly higher, 4.5. MIBOR for, let's say, 18 months maturity will be, let's say, 5% per annum. I'm just giving a hypothetical example. 2 years, it can be 5.5%. 5 years, it can be, let's say, 7% per annum. So that's how it happens. Always, lowest maturity will have the lowest rate of interest on a per annum basis, and higher the maturity, it will be higher. Can anyone tell me why? Even there is a possibility of MIBOR 1-day rate. This is called as overnight rate. Overnight means that you are just giving a borrowing for 1 day, 1 night. Today you are giving and tomorrow they are supposed to give you back. It will be, let's say, 1% per annum.
Because fund got blocked for longer period. So bank
Okay,
may lose the opportunity to invest it somewhere else for a higher return.
perfect. So that is one. That
And
is a reinvestment risk that you're talking about.
and the risk increases as the tenure increases.
Yes, correct. The risk increases as tenure increases. This is a very, very important point. The moment you talk about that, if I will give you a loan for 10 years, there are high chances that within 10 years, I might not get the principal, I might not get the interest. But if I say that, okay, I will give you a borrowing for one night, which is today, so there are very low chances that the other person will go bankrupt within one day and will not be able to pay me back. So the risk is negligible, right? So the risk is negligible, risk of non-payment. And this I am again linking it back to the very first topic that I discussed here, which was why do you pay interest? Interest is paid because of two reasons. One is time value of money. Second is risk of non-payment. If the risk of non-payment is very low, then it will be zero on account of this, and whatever is time value of money, I will be charging for it. But the moment you keep on increasing your tenure, your risk will also increase, and hence your interest rate overall will also increase. Clear? So, coming back here, so first of all, don't get confused by the term MIBOR overnight floating rate. This is a very simple terminology which says that on a maturity of a daily basis, you will have to take the MIBOR. Okay, clear? So take the maturity of the MIBOR which is getting matured on a daily basis. Clear? Now, let's come back here. Clear, students? What is the meaning of overnight floating rate? That means the maturity of is only for one day. That's all. So first of all, the question is asking us to share the nature of this swap arrangement. So the given swap is a plain vanilla overnight index swap. So this is called as overnight index swap. Why we are saying plain vanilla? So plain vanilla is basically which is not where there are no other terms and conditions that are added. There are no ifs and buts. It is a very straightforward swap wherein you are just giving a floating rate and you are receiving a fixed rate. Or you are giving a fixed rate, you are receiving a floating rate. Right? So it's a plain vanilla overnight index swap. OIS. Overnight index swap. Okay. Then calculation of net settlement amounts. So let's put down the days first of all. We will start with Tuesday, right? It was mentioned in the question that 19th August to commence on 20th August. So swap was entered into Monday, but it was to start from Tuesday. So Tuesday, Wednesday, Thursday, Friday, Saturday and Sunday. I'm just clubbing these 2 days together, right? Because Sunday there is no separate working. That's why we will take both the days together and then Monday. Okay, so these are days we have plotted it. Then let's talk about the running principle. Now students, we will change the principle also every day, right? Because this is a overnight index swap. The nature of this is that for overnight itself we are lending or borrowing, right? So if for today, if my interest amount is 10 rupees, so for tomorrow the principal plus 10 rupees will become my another principal. Okay, so let's start with the opening principle of 10 crore rupees. Okay, what is the MIBOR percentage on Tuesday? 8.15. The interest part, students, we just need to calculate as 10 crores multiplied by 8.15 percentage for 1 by 365. Okay, which is approximately 20 to 329. This is the interest for 1 day. Why we have taken 365 days, students? Because it was mentioned in the question that assume 365 days in a year. So it becomes 22 329. So this becomes on Wednesday 10 crore plus 22 329. It becomes 10 crore 22 329. MIBOR is 7.98%, right? On the second day, which is this. So now, instead of 10 crore, the principal amount will be the opening on Wednesday, right? Which is 10 crores, 22 329. This becomes the opening principal amount multiplied by 7.98 percentage into 1 by 365. If you solve this, the amount comes out to be 21,868. Right? Now what we will have to do, Wednesday opening principal plus interest becomes the Thursday opening principal, which is 10 crore 44,197. 7. This becomes the opening principal. 7.95 percentage is the interest rate. So now it becomes 10 44 197 multiplied by 7.95 percentage into 1 by 365. Again, the same level of working. So for Thursday, the amount comes as 21,790. Now for Friday, we will again add it back 21,790 to the Thursday's opening amount. So this becomes 10 00 65,987. 8.12. Okay. Now again it will be 10 65 987 multiplied by 8.12 percentage for 1 by 365 days. So for Friday, the interest comes out to be 22,261. Now the opening for Saturday and Sunday will be the opening for Saturday, right? Which is closing of Friday, which is 10 crore 65,987 plus 22,261, which is coming out to be 10 crore 88,248. This is a 8.15 percentage. Now please remember, this is for 2 days. The interest will be charged for 2 days. Although Sunday is a holiday, don't think that if Sunday is a holiday, the interest will also not be levied. The interest will also be there for 2 days. So we can just put 10 crores 88,248 into 8.15% for 2 by 365 days, students. So it becomes 44,697. Then on Monday, if we add again 44,697 to the Sunday's closing, it becomes 110 crore 1 lakh 32,945. So this is effectively 7.75 percentage. Again, for 1 day is what we will have to calculate. So it becomes 10 crore 1 lakh 32,945 into 7.75% into 1 by 365. So the amount comes out to be 21,261. And the total amount to be received. So the floating rate we are receiving, right? Agree to receive MIBOR overnight floating rate for a fixed payment. So the amount that will be received is the total of this, which is 154,206. Fixed amount to be paid is 10 crore into 8%, right? Yes, fixed rate is 8%. Okay. Then multiplied by 7 divided by 365, which comes out to be 153,425. This will be paid and floating will be received. So net amount to be received is 781. Clear, students? So the net amount received will be 781. That is the second part of the question. Yeah, okay, B. Kiran Kumar. Thank you. This is all your efforts only. Perfect. So this brings us to the end of question number 6. Okay. Any doubts, any queries, students? Please do let me.
Yes, sir. Sir,
Yes.
while calculating interest, though Sunday is holiday, why we have applied 2 days? Why not separately for Saturday, then for Sundays? It will give higher amount.
You're right. You can do that as well.
Okay.
You can do that as well. Yeah. Even for the same logic, I would say this 7 days we have multiplied at the same length. Ideally, it should be 1 day interest, then on that 8%, then 1 day interest on that 8%. Even that logic is also okay.
Okay. Thank you, sir.
Okay. Perfect. So let's break for quick 10 minutes and then we will again reconvene to take the further topics ahead. Thank you. Let's come to question number 7. A Inc. and B Inc. intend to borrow $2 lakh and $2 lakh in yen respectively for a time horizon of 1 year. So they are saying that A Inc. wants to borrow in $2 lakh and B Inc. wants to borrow $2 lakh but in yen. Okay. The prevalent interest rates are as follows. For yen loan, it is 5% and 8% for A Inc. and B Inc. respectively. And the dollar loan is 9 and 10% respectively. The prevalent exchange rate is $1 is equal to 120 yen. They entered in a currency swap under which it is agreed that B Inc. will pay A Inc. at the rate of 1% over the yen loan interest rate which the latter will have to pay as a result of the agreed currency swap. Whereas A Inc. will reimburse interest to B Inc. only to the extent of 9%. Keeping the exchange rate invariant, quantify the opportunity gain or loss component of the ultimate outcome resulting from the designed currency swap. So students, this is a peculiar question on currency swap and the interest rates. So first of all, let's try to disseminate the facts first. The preferred borrowing is A Inc. in the form of dollars, B Inc. in the form of yen. This is their preferred borrowing. But because of swap, so they're saying you have to devise a swap in which, let's say, the B Inc. will pay to A Inc. 1% over the yen loan interest rate which the later will have to pay. Later will have to pay means A Inc. will have to pay as a result of the agreed currency swap. So A Inc. will take a yen loan in 5%. So 5% plus 1% over and above this B Inc. will pay to A Inc. So in totality, B Inc. will pay to A Inc. at 6%. Clear? So what is happening here, students? B Inc. is paying to A Inc. 1% over and above what A Inc. will pay to the yen loan borrowing. Whereas A Inc. will reimburse interest to B Inc. only to the extent of 9%. At the rate of 9%. So A Inc. will pay to B Inc. at the rate of 9%. Okay. Now, let's put their preferred borrowing. So A Inc. will prefer in dollars and hence 9%. Which is this one. B Inc. prefers yen loan which is 8%. In totality, this is 17%. This is option 1. So let me just write it as option 1 Okay. B Inc. and A Inc. borrows as per their preferences. Option 2 borrows as per their, as opposed to their preferences. So A Inc. borrows in yen and B Inc. borrows in dollars. So the rate that is applicable will be 5 and 10. In totality, this is 50%. This is option 2. So 17 and 15. So these are two options for designing the swap. The above are two options for designing the swap. Now within this, which option will you pick and choose, students? Come on. The option 1 or option 2?
2.
Yes, option 2. And the reason for this option 2 will be because it's 2% cheaper than option 1 and it is giving to the most optimum results, right? So option 2 is leading to the most optimum borrowing cost. And hence the same should be used as designed currency swap. Now, as a result, following swap payments are agreed. This was given in the question, right? A would pay to B a fixed rate of 9%. B would pay to A 1% plus 5%, which is actually 6%. Okay. And if we are going to put it over here, A Inc., B Inc., Swap Bank, now A Inc. is borrowing in yen, and hence A Inc. will pay 5% here. B Inc. is borrowing in dollars, which is as per option 2, right? And hence B Inc. will pay 10%. So this will result into A Inc. paying to Swap Bank around 9%, right? And in a way, Swap Bank paying to B Inc. as 9%. B Inc. will pay to Swap Bank. Swap Bank will pay to A Inc. as 6%, right? This one, what we have agreed. I think the question is silent about the Swap Bank's commission. So let's not talk about that because which is not given here. So what is the overall story here for A Inc.? So let's kind of put it like this. Overall interest cost to A Inc., right? So 5% pay for yen borrowing plus 9% pay to B Inc. under swap minus 6% receive from B Inc. So this becomes 8%, right? Similarly, overall interest cost to B Inc. So 10% pay for dollar borrowings plus 6% pay to A Inc. under swap minus 9% receive from A Inc. So this becomes 10 plus 6, 16 minus 9, which is 7%. Okay. So if we add both 8 plus 7, 15%, this is the overall cost as per option 2. Hmm? Opportunity gain slash loss for A, we are computing in dollars. Okay. Now one, interest to be remitted to B Inc. $2 lakh multiplied by 9% for 1 year. This is 18,000. Second, interest to be paid to bank for yen borrowings, right? Because with the bank it is doing a yen borrowing, so it will borrow 240 lakhs, right? Because 1 is equal to 120. On that, it will pay 5%. But since we are calculating it in dollars, we will again reconvert it back to dollars, the yen amount. Because till here, this is the yen amount. And overall, it will become dollar amount. Clear? So it will come out to 10,000. Third one, interest to be received from B Inc. $2 lakh into 6% into 1 year. So this is what we are going to receive in terms of 2 lakh rupees for 6%. So 18 plus 10, 28 minus 12, $16,000 is what interest cost is going to be. Interest cost under swap. Then interest cost without swap, students. It comes out to be $2 lakh into the A would have borrowed in its own preference, which was 9%, right? This one. $18,000. That means opportunity gain is $2,000. Clear, students? Okay. Then the next part, let's come to B Inc. Interest to be remitted to A Inc. So this we will be calculating in yen, students. Okay, because the preferred borrowing for this is yen. So we will put everything in yen. So 240 lakhs into 6% into 1 year, right? This is what the cost that will be paid to A Inc. So 1440,000. Then interest to be remitted to bank for dollar borrowings. 2 lakh is the principal amount multiplied by 10% multiplied by 1 year multiplied by 120 is the exchange rate, right? So 24 lakhs. Then third, interest to be received from A Inc. $240 multiplied by 9% for 1 year, which is 2160. Okay, 2160. So the net interest cost under swap is 1680. Interest cost without swap. $19,20,000, because then being would have ended up paying 8%, right, in the yen borrowings. So the opportunity gain is 240,000 yen, which is opportunity gain on account of swap. Okay, clear, students? So now let's move to question number 8.
Sir, it is
Yeah.
Sir, it is necessary to be the currencies has to be hetero in case of swap arrangement, like
Yeah.
dollar rate. It can't be dollar to dollar and yen to yen.
No. It cannot be. Otherwise, there will be no swap. Na? So for swap to happen, let's say the situation is this only. Let's say what you are preferring is not what you want to enter into.
Okay.
See, because in this case, they are trying to swap their currency risk, right? In a way to answer
Yes.
your question, because the
Yes.
swap will happen to mitigate a risk. It can be a interest rate risk. It can be a currency risk. In this case,
Yes.
it was currency risk. Okay.
Thank you, sir.
Okay. Thank you. Now let's come to question number 8, students. A textile manufacturer has taken floating interest rate loan of rupees 40 lakhs on 1st April 2012. Sorry. The rate of interest at the inception of the loan is 8.5% per annum. Interest is to be paid every year on 31st of March. And the duration of the loan is for 4 years. Clear? So every 31st March, the interest has to be paid. So let's put it in a timeline. 1st April 12, then 31st March 13 is the first year. 31st March 14 is going to be the second year. 31st March 15, and then 31st March 16 is going to be the third year. In the month of October 2012, which is here, the central bank of the country releases the following projection about the interest rates likely to prevail in future. So what is their prediction? Central bank's prediction on 31st March 8.75, 14 it is 10%, 2015 10.5%, and 16 it is 7.75%. Show how this borrowing can hedge the risk arising out of the expected rise in the rate of interest when he wants to peg his interest cost at the rate of 8.5% per annum. That is the maximum amount that he can pay. Assume that the premium negotiated by both the parties is 0.7% to be paid on 1st October 2012, and the actual rate of interest on the respective due dates happens to be, what is the actual interest rate? 10.2, 11.5, 9.25 and 8.25. Show how the settlement will be executed on the prospective interest dates. Now, if you see, they are saying that the premium is negotiated and the maximum amount of interest that they are willing to pay is 8.5%. So, which instrument we are talking about here, students? Come on, tell me. Are we talking about forward rate agreements? Are we talking about interest rate futures? Are we talking about interest rate options or guarantees? Or are we talking about the swaps? Which instrument are we talking about? We are talking about premium and pegging the interest at 8.5%. Come on, students, think and tell me what is this that we are talking about?
The forward contract?
No, there is a premium involved. Just see.
Contract.
Sorry?
Option contracts.
Correct. Option contracts, which is the interest rate guarantees, right? Because they have clearly mentioned that there is a premium involved in this. And he wants to peg means maximum. He wants to put a cap at 8.5%. So we are talking about a cap option. Okay. So textile manufacturer needs to enter into interest rate guarantee, which is a cap option with a strike rate of 8.5% upon payment of premium at the rate of 0.75% on October 1st, 1st October 2012. Clear? We can do the simple calculation now. It's simple mathematics. So time in October 12, the calculation of premium will be 0.75% on 40 lakhs. 40 lakhs was the borrowing amount, right? So this comes out to be 30,000. So this is going to be a cash outflow of 30,000. Then comes the first date of March 13. So interest rate option was entered at 8.5. Now tell me, students, if the actual interest rate is higher than 8.5, then will the option be favorable or unfavorable? If the actual interest rate is 10.2%, the cap option rate is 8.5%. Do you think the option is favorable or unfavorable?
Favorable.
Favorable, yes.
Favorable, because I have entered into a borrowing situation. In the market, I can borrow at 10.2, but I have an option to borrow at 8.5. That means my option is able to give me a 1.7% benefit. into 40 lakhs into 1 year. So this will become 68,000 will be my inflow because of the option. So you understand, premium is an outflow and the differential is received. So this will be received by the textile manufacturer. On option exercised. Now let's come to March 14. The actual interest rate is still higher, 11.50. So this is going to give me a 3% gain, which is 1,20,000. This is also going to be my cash inflow, students. Received by textile manufacturer on option exercised. March 15, students. Where are we now? 9.25. The actual interest rate is operating at 9.25. Now, 9.25 minus 8.5 multiplied by 40 lakhs for 1 year. Is it still going to be beneficial? Yes, it's still going to be beneficial. 0.75%, right? Which is 30,000 INR in cash flow, inflow. So this is also received by textile manufacturer on option exercise. This is March 2015. March 2016 now. What is the actual interest rate? 8.25. 8.25 is lesser than 8.5 for 1 year. Come on, students, tell me. This is an interest rate option. Should I be paying this differential of 0.25%?
No.
Yes, very good. Had this been, okay, now I'm testing the question. Had this been an interest rate future or a forward rate agreement, then would I have ended up paying the amount of differential?
Yes.
Yes.
In that case, yes, because in that case, I have an obligation. I will have to fulfill the obligation. Here I have an option. If the situation is beneficial, I will opt it. If it is not, then I will not opt it. So here the manufacturer will not exercise the option open market rate should be accepted by textile manufacturer. Clear? Okay, students, clear? Let's come to question number 9.
Sir, then what will be the use of the interest rate given as per the bank projection, central bank?
So yeah, so this was just an indication on October 2012 that the interest rates are going to rise. And basis that indication, the textile manufacturer has taken a decision that it will want to cap at 8.5%. That's the only use.
Okay, sir.
Okay. So that has gone into the input into the decision making of the textile manufacturer. Okay. Okay, let's come to question number 9. Okay. The Drill Dip Inc., a US based company, has won a contract in India for drilling oil field. The project will require an initial investment of 500 crores. The oil field along with equipment will be sold to Indian government for 740 crore in 1 year time. Okay. So the initial investment is 500 crores. After 1 year, it will be sold to the Indian government for 740 crores. So if you see from drill dip point of view, it will pay 500 crore and it will receive 740 crore. Pay and receive. Receive after 1 year, but okay. The oil field along with the equipment will be sold. Okay, this is done. Since the Indian government will pay for the amount in rupees, the company is worried about exposure due to exchange rate volatility. This is obviously a case because this is a US based company. They will be having dollars as their own currency. So you are required to construct a swap that will help drill dip to reduce the exchange rate risk, which is fine. Assuming that the Indian government offers a swap at the spot rate, which is $1 is equal to 50 rupees in 1 year, then should the company should opt for this option or should it just do nothing? The spot rate after 1 year is expected to be $1 is equal to 54 rupees. Further, you may also assume that drill dip can also take a US dollar loan at 8% per annum. So the rate of interest for dollar borrowing is 8% per annum. Okay. So if you see currently the swap available is at rupees 50, $1. Forward rate is rupees 54 is equal to $1. Then interest cost is actually 8%. Okay. Now the question is first of all asking us that what is the swap arrangement possible? Let's go to the solution now. The following swap arrangement is possible. Initial arrangement. One, swap a US dollar loan at an agreed rate to obtain Indian rupee to make initial investment, right? Because for initial investment also you will swap a US dollar loan at an agreed rate to obtain Indian rupees to make initial investment. So what it will do, the US dollar company will give dollars locally to a bank. The bank will give the US company 500 crore rupees and the US company will invest that 500 crore rupees in India. So there is a swap that has happened of the US dollar and the INR for investment. After 1 year, swap bank okay, let's write it swap. So let's say after 1 year, then again you are swapping it back. The US dollar you are receiving and then you are paying the INR. Swap back the Indian rupees to US dollar at an agreed rate. In such case, the company is exposed only to the profit/loss earned from projects and not due to foreign exchange. So students, this is somewhat similar to the situation that I have explained earlier, right, before the break, that you swap today basis one exchange rate and then you swap later on also basis an agreed exchange rate so that you are not exposed to the volatility of such amounts. Okay. Now, we say that let's say the company opts for swap. We are talking about the B part now because in that case it has asked us whether the company should opt for swap or it should just do nothing. So let's say we are saying that the company opts for swap, that is for the 50 rupees per dollar, right? So year 0 and year 1, we have two different periods for the cash flows. We are talking about the dollar millions because the company will do calculation in dollar millions. So in the first year, they will buy 500 crore INR to invest, correct? So that means there will be an outflow of $100 million because $1 is equal to 50 rupees. Okay, clear? After 1 year, again you will swap back 500 crores INR on maturity, right, which is at the rate of 50 rupees. So you will get back $100 after year 1 for up to 500 crore because the swap is happening, right? 500 crore is to $100 million. So that will happen as on today, and that the same swap reverse order will happen after 1 year. So today you will pay $100 million. After 1 year, you will receive $100 million. Then what you will do? You will sell
But after
40
1 year,
crores.
it is 54. Exchange rate is 54.
Correct, you're right. So, but for the swap, the rate, as I said in my example also, right? The swap will happen at the same rate today and after 1 year also, because that is the meaning of swap. Today you will swap dollar for rupees. After 1 year, you will swap rupees for dollars at the same rate. The balance 240 crore you will be selling at the forward rate of 54. Forward rate of 54. So this comes out to be $44.44 million. So this is simply 240 crores divided by 54. Okay. Then we will also less the borrowing cost because you would have borrowed at the rate of 8% on $100. Correct. So we will also reduce $8 million from this. So here it is $100 million outflow and here it is $136.44 million inflow. So the net receipts of US dollar will be 36.44 million. Now, the second case is that the company is not opting for swap. We will compare that as well, right? Company opts for no swap. Now in such a case, again year 0, year 1, we will buy 500 crore at the rate of 50 rupees spot rate. 100 million will be the outflow. Then you will sell entire 740 crore. I hope now you can make it out at the rate of 54 per dollar. So here you will sell the entire 740 crore at 54 rupees per dollar. Okay, so
Because
the
we don't
point that
have a swap contract here, no sir.
sorry?
Because we have don't swap the currency, so we have a
Correct. Because we have not swapped, because we have not entered into swap, and hence we will sell the entire 740 crore at the forward rate of 54. So here it comes as 137.04 million. Right? So this is coming how? 740 crore divided by 54. But this we will have to convert into millions. Right? So into 10 we will have to do. Similarly, in the above case, here also into 10 we have to do because that was in crores, right? So this comes out to be 137.04. Then again, interest also needs to be paid at the rate 8% per annum on $100 million. So this will be minus 8 and hence minus 100, and here it will be 129.04 is the overall amount. So the net receipt will be 29.04 million students. So this is going to be the net receipt. Now what is the final decision, students? Come on, tell me, should we enter into swap or should we not enter into a swap?
we should enter into the contract swap contract, sir, because it will have the gain of rupees 5 with this an exchange
Correct.
over the 500.
Correct. So since the net receipt is higher in swap option, the US company should opt for the same. The US company should opt for the same. Okay, clear? See, the idea behind this is, let's say this is the Indian economy. Okay, just to avoid confusion, I am just writing it here. While you invest into the Indian economy, let's say here it is US, you are investing $100 today at the rate of 50 rupees per dollar, right? So that means 500 crores you are investing. Now, while you are pulling your money back, the rupee gets depreciated, correct? So $1 is equal to 54 rupees now. While you are doing this, then you will end up getting lower number of dollars, which is 92.6 million. Because your lower number of dollars are coming out, so there is a loss because of the foreign currency loss, right? Hence, the second option of not entering into a swap is making you a worse off. You're getting the point? So, what you will have to do, you will have to enter into a swap at the rate of $1 is equal to 50 rupees. So as you can avoid this gap of around $7.4 million. Clear? Let's come to question number 10, students. Let me just quickly check if there are any queries. Okay, perfect. Please do ask, students, in case something is not clear. Okay. Now, question number 10. IM is an American firm having its subsidiary in Japan, and JI is a Japanese firm having its subsidiary in USA. So USA is having in America, America is having in USA. So both of them are having their own subsidiaries. They face the following interest rate. So IM and JI, if they want to borrow in the USD floating rate, they will have SOFR plus 0.5 and SOFR plus 2.5. JPY, they will have 4% or 4.25%. IM wishes to borrow USD at floating rate and JIJY at a fixed rate. So they are saying that IM has a preference to borrow at a floating rate in USD and JI to borrow JY at fixed rate. The amount required by both the companies is same at the current exchange rate. A financial institution requires 75 basis points as commission for arranging the swap. So they have clarified 0.75% will go to the swap bank. The companies agreed to share the benefits or losses equally. That means after paying 0.75%, whatever is the gain left. Sorry?
If the gain left, it will be divided into 0.5
Equally. Correct. Okay, now you are required to find out whether a beneficial swap can be arranged and what rate of interest for both IM and J. So simple, we will just curate two options. Option 1 as per their preferences, option 2 not as per their preferences. And then we will see what is beneficial or not.
Sir, here one thing I have a doubt. Uh, Whether they want a loan for their subsidiary company or for their region.
So see, if IM wishes to borrow USD at floating rate, that means they would be borrowing it for, let's say, their own usage, right? That is what I have an assumption for. But even if they want it for their own usage, they can take the loan and they can always give the loan to their subsidiary as well, right? So it is immaterial whether they would use or whether they will share it with them. The logic or the calculation will remain same. Okay. So IM has a preference to borrow USD at the rate of floating. JI has a preference to borrow at Japanese yen at fixed rate. Okay, so these preferences we will have to remember. So option 1, IM in dollars plus JI in JPY. Okay. So USD floating rate is SOFR plus 0.5%. So meaning of SOFR is secured overnight financing rate. Okay. So this is again an overnight financing rate, which is, that's why it is called as secured also, because the chances of counterparty risk is very negligible. And JI JPY rate is how much? JI JPY rate is 4.25. So this comes out to be SOFR plus 4.75% as an overall option 1. Option 2 is IM at JPY that they are charging and JI at dollars rate if they are borrowing. So IM, if they borrow in JPY fixed rate, it is 4% plus JI at JPY, sorry, at USD floating rate is SOFR plus 2.5%. So if they borrow at without their own preferences, then it will be SOFR plus 6. Sorry, this is 2.5. Yes, so this will be SOFR plus 6.5% students. So option 1 is giving you SOFR plus 4.75%. Option 2 is giving you SOFR plus 6.5%. Okay. Just a second, students. The question is saying IM is an American firm having subsidiary in Japan and GI is a Japanese firm. Okay. So they wishes to borrow USD at a floating rate, which is fine, and JPY GI is a fixed rate. So those are the same. The current okay. So okay, if we see the differential part between option 2 and option 1, it comes out to be 1.75%, and option 1 is what they will choose to be executed, right? Now within this option 2, the financial intermediary will ask for 0.75 percentage as its own commission. Now how much will be left? 1%. This is savings. So savings after financial intermediary is 1%. Now in this, the share of IM and the share of JI will be 0.5 and 0.5%. Okay, since the savings of 1% to be shared equally amongst IM and JI, the interest rates shall be, let's take the amount that what would have been their actual interest outflow. So borrowing from market, they are doing as per option 1, correct? Which is SOFR plus 0.5% less benefit from swap, which is 0.5%. So ultimately they are paying a net interest equivalent to SOFR itself, SOFR itself. Okay. Then for JI, borrowings from market will happen at 4.25% as per option number 1. Benefit from swap 0.50. 3.75% becomes their net interest cost. So because of the swap, there was a total 1.75% gain got generated, and 0.5 was kept by both the companies, JI and IM. This is for IM, let me put it. And hence their overall cost is, for IM it is SOFR, and for GI it has become 3.75. Clear, students? Any doubts, any questions till now?
Sir, for IM, in last line comparison, it is a SOFR plus 0.5, or what is the rate given in the question?
SOFR plus 0.5.
It's
Because
0.5
they have,
only. Okay.
yeah.
Okay, sir. Yeah.
Okay.
Yeah, thank you.
Thank you. So this I have explained that the shorter maturity rate of interest is lower and the longer maturity rate of interest is always higher, right? Okay, there is one more concept. Just 2 minutes I want to spend on that. In theoretical topics, it is given. Okay, there are types of interest rate risk. In that, there is one topic of gap exposure. Okay, so I will quickly cover this. So, what do we mean by gap exposure? So, students, the assets minus liabilities. Simply, if I put, it is one sort of an exposure to me. But in gap exposure, we take interest rate sensitive assets and interest rate sensitive liabilities. So, what do we mean by interest rate sensitive assets or liabilities? The value of those assets or liabilities depends on the interest rate. Let's say today, for example, a bond that you have issued. If the rate of interest goes up, the bond value will go down, right? Whether you have invested or whether you have issued, right? So those are called as interest rate sensitive assets or liabilities. Now, if your interest rate sensitive assets are higher than interest rate sensitive liabilities. Now, students, please note, all the liabilities are not interest rate sensitive liabilities and all the assets are not interest rate sensitive assets. We are only taking from the balance sheet which are interest rate sensitive. Here we call that the gap exposure is positive. And where interest rate sensitive assets is less than interest rate sensitive liabilities, we say that the gap exposure is negative. Now, if the gap exposure is positive, if the interest goes up, the net interest income will also go up. Net interest income will also go up. But if the interest rate goes down, the net interest rate will also go down because the asset base is high. If the interest rate goes up, your assets will go up, right? The income on assets will go up. And there is an inverse relationship here. In case the gap is negative, where your liabilities are higher than the assets, then your interest rates, if they will go up, your net interest income will go down. And if your interest goes down, then net interest income will go up. So it's inversely related. Okay, students, now quickly come to some of the MCQs planned for today. I would request all of you to answer this and put the answer in the chat box. Don't verbalize it so that rest all of you can answer. Which of the following best describe the interest rate risk? Risk of changes in foreign exchange, risk of changes in interest rates affecting the values of assets and liabilities, risk of default by the borrower, or risk of liquidity shortage. Come on, students. you can just answer in the chat box. The correct answer will be, we have given A, B, C, D. You can just type the right option in the chat box. Yes, very good, Leela. You are right. I would suggest all of you to please participate in the MCQs. This will quickly help in the revision as well as testing of the knowledge. Yes, the right answer is B, students here, because it risk of changes in the interest rate affecting the values of assets and liabilities. Which instrument is commonly used to hedge against the interest rate risk? Is it currency future? Is it interest rate swap? Is it equity optional credit default swap? Come on, students, tell me. Which instrument is used to hedge against the interest rate risk? It's a very easier one. Do you use currency futures? No. Do you use equity options? No. This is used to do the price risk. Yes, Bibu, your answer is right. The right answer is B. Then, in an interest rate swap, the most common exchange is between the fixed and the floating rate and the currency payments, fixed rate and equity returns, floating rate and commodity prices. Come on, students. We are talking about plain vanilla swap. Plain vanilla swap happens between fixed and floating or floating and currency. Yes, Bibu, you are correct. The answer is A. I request all of you also to please answer. Which of the following is not a type of interest rate derivative? Interest rate futures we discussed, options we discussed, forward rate agreements we discussed. Now what is left, students? The right answer of what is not the type of an interest rate derivative is D. Yes, you are right. Correct answer is D. A forward rate agreement is used to. Yes, Sanjay, your answer is correct. A forward rate agreement is used to lock in a future exchange rate. Okay, lock in a future interest rate, hedge against commodity price risk, hedge against equity price risk. So we are talking about the forward rate agreement, students. We are not talking about commodity, equity, and price risk. So the correct answer is lock in a future interest rate. Yes, Sanjay, you are correct. Bibu, you need to just check once. This is a future exchange rate. We are talking about the interest rate. Okay. Let's quickly come to question number 6. If a company expects interest rate to rise, which position it should take in the interest rate futures? Please do note, we are talking about interest rate futures. Futures are inversely proportional to the bond prices. The interest rates are inversely proportional to bond prices. So should we go long on futures, go short on futures, buy call options on interest rates, or do nothing? Which position it should take on the interest future, students? Come on, tell me. If the interest rate is expected to rise, we should take a long position on futures or a short position on futures, depending that these futures are bonds futures. Okay, Leela is saying, yes, Bibu, you are right. So it should be go short on futures, because if the interest rate is rising, the bonds will go down. Okay. Then, which of the following statements about duration is true? Okay, this one you can leave it. Which of the following best describes a cap? Interest rate options. Cap in the interest rate option, a contract that sets a minimum interest rate, maximum, both minimum and maximum swap. This one is very easy, students. The cap is the, yes, very good. The answer is right. B, correct, Bibu, you're right. Which of the following is the primary objective of the interest rate risk management? To maximize returns from the interest rate movement, to eliminate all financial risk, to minimize the impact of interest rate fluctuation on the firm's value, to speculate on interest rate changes. Which of the following is the primary objective? To definitely mitigate. Yes, your answer is correct. The answer is C. Yes, Leela, you are also right. So, student, this brings us towards the end of the session. We have completed the interest rate risk management topic. I now request CA Ashish sir to help with the concluding remarks. Thank you, students. Thank you, sir.
Am I audible?
Sir, you are audible.
Yes, sir. अशोक जी मेरे को माइक कैमरा एनेबल कीजिए. अशोक जी. Thank you, Divas sir, for complete enlightening the student on this topic, interest rate risk management. Now, with this, we have come to the end of the portion of risk management. We can say risk management major portion. Almost complete. We have completed because we have completed a foreign exchange exposure risk management, and then we have completed the interest rate risk management. Now, with this both of topics, we can say that a major portion of your, and we can say that is one complete section. I think it is a section 4 has been completed. Now, next section is section 5 that will consist of 2 chapters: business valuation, merger acquisition, corporate restructuring. So, with this, we have come to, you can say that almost we are about to cover 80% of our syllabus. So, student, as I request in every class, please you revise whatever has been discussed in this class. So these are our contact number and this is our email ID. And I'm very really happy. In the last class after the session, one student has given me a call and he has requested for some improvement in the class. So I thank you that student, because of this number he has contacted me. So that's why in every class I share this number. So student, please feel free, even though you are not joining from the Zoom link. My request to you, you can join through the Zoom link because it makes the session more interactive and sometimes it resolves your query on real-time basis. So even though, but still if you have joined through the YouTube, so please contact me over this telephone number so that we can improve upon our classes further and that will benefit for the future students to come, and even we can clarify your doubts as well. So students, thank you very much for patient listening and making the session very interactive. And thank you, Divas sir, once again.
Thank you, sir.
And have a nice day. Thank you. Thank you.
Thank you, sir. Very nice.
Yes, sir.
Sir, I have a question that one of my friend who want to join BOS, he is not able to join from BOS mobile, and I have the mobile of OnePlus Android. The version is not supported. The Zoom class cannot be supported in him. I have tried from my another friend's phone also.
Ajit, one second. Ajit, just listen to the query of the student. He's saying you Android. Samanathan, it is from iPhone problem, na?
Android. In Android.
So he's facing the problem. I'm just sharing one number with you. Okay.
Yes, sir.
You contact. You give this number to your friend. He will. Mr. Ajit is there. Okay. He will help you out. Okay. Just note down the number. Divas sir, just write down the number.
Yes, sir. Yes, sir.
0120 38 3876 859. Okay, Mr. Ajit will be there. Samanathan, you just tell him to contact him. Okay.
Okay, sir.
And if the problem persists, then you please let us know. Okay.
Thank you, sir.
Am I right? But I sorry, I took wrongly your name. What is your name? But you have asked the question.
Vibhu Pandey.
Vibhu Pandey. Okay, Vibhu Pandey. Thank you very much. Okay, so if you just tell your friend, we will sort out this matter. Okay.
Okay, sir.
Okay. Thank you, sir. Thank you. Vibhu.
Okay. Thank you, sir. Thank you, sir. Thank you.
Thank you, sir. Thank you, sir.
Thank you.
Thank you. Have a nice day.